Right, friends, let us just straight away resume our discussion. So, previous class we discussed something about your mutual funds. In terms of a mutual fund related discussion, if at all there was any incremental learning, there was only one I would consider, something about accounting for investments in the books of your mutual funds. Yeah. What else did we actually learn? We saw something about net asset value that we have been learning since our school days, or rather at least IPC's race for net asset value per share for a company's equity shares. We saw something about accounting for what is that? Yeah, dividend equalization reserve. That was okay. That was a new idea yet again. The render again, at least we have been coming across those terms, dividend equalization reserve for quite some time. At least I hope now we are relatively clear as to what exactly was the purpose, intention, method of creation, method of utilization about your dividend equalization reserve. Of course, and then we saw something about investments being accounted for in the books of mutual funds. The core idea about accounting for investments in the books of mutual fund is very simple. You are required to carry them at their fair value or market value. For most of your listed securities, market price is considered to be the fair value. So at that price, you are required to carry those instruments or investments in your books. Moment you decide to carry them in your books at market value as against the original cost or historic cost, how do you go about recognizing the resultant gains or losses on restatement? So now we have to see. And we saw that any kind of gains were straight away credited to unrealized appreciation reserve. Any type of losses were actually accounted for by creating a provision instead of adjusting your investments directly. Any kind of provision that you created was actually done what will be shown as a reduction from your cost of investments or carrying amount of your investments. This is the basic pattern when it came to your accounting. At the time of sale, we did see that all your gains or losses, the actual gains or losses are accounted or considered after considering whatever be the balance in unrealized appreciation reserve or provision for diminution in investment value. This is what we managed to discuss in your previous class towards end. I would consider the last idea as a bit more relevant and important one than the opening idea of net asset value. But again, only three ideas essentially: net asset value, your accounting for dividend equalization reserve and uses of dividend equalization reserve, and then finally accounting for investment. Just three simple little ideas. And three simple little ideas, either of these questions and ideas can be tested for anywhere between 6 to 10 marks. So do prepare yourself for that kind of question. And easy to score here as against all that pretty laborious idea that we managed to have as part of your consolidation, and we will be having as part of say amalgamation sometime later. But these are relatively simple ideas, easy to score. That is what we are I'm emphasizing repetitively, guys. So what is that we'll be dealing right now? So there was end of mutual funds also. So what is that we'll be dealing in the current class? Straightforward, something about financial instruments. The now notorious, part popular, part notorious, part intimidating, part irrelevant, part joke kind of stuff. So what is that stuff now? Is number 30, 31 and then 32. So this is what we'll be taking up right now. In fact, many students know, like when they were giving their exams sometime in 2010, 11, 12, around that time, people, most of them right now become CAs. They used to dread this accounting standard. They were like, we're worried. I can avoid all this kind of nonsense. But it was pretty much a scary stuff, at least at that point in time. Not that, these were for the first time being brought in. Some of these ideas that we are going to see were in existence even earlier through guidance notes. There were guidance notes for accounting for stock market futures, stock market indices. You got like various guidance notes for accounting for options. There were guidance notes. The trouble was that our people never read those guidance notes in those times. And the moment there was a standard, mandatory guidance note, recommendatory kind of distinction and all, people started having, they thought that their own, life could become miserable by merely reading something once it becomes standard instead of it being a guidance note. So effectively, despite all the hype and hoopla, it is practically the same as whatever you had earlier. So this actually at a very specific level, specific issue would require us to understand the financial management part of it. As in when I say financial management part of it, I'm just focusing on the conceptual implication of one or two items of derivatives, how they typically operate, what will exactly happen kind of stuff. That is what we are required to understand as part of the discussion. That is all that is required to keep in mind this. When it actually reaching that level, I will specifically explain what exactly we are supposed to do. But for the time being, we'll hold on to those ideas separately. We'll just take up on a very, very simple fashion. We'll be oscillating between one idea, the other idea, bit of a theory, bit of an application. We'll be proceeding this way, that way, but try to keep track. And towards end, we'll just start summarizing. Then it should basically start making some amount of sense. Question number 1. What is a financial instrument? What exactly is a financial instrument here? Yeah. What do you think could be a financial instrument? Yes, please. That is financial instruments. Instruments with monetary value. Traded in open market. Everything will have a monetary value to trade in the open market. Bill of exchange. Financial asset. Sure. Check. Financial asset. Financial instrument. Now please understand, your financial instruments is technically correct. The financial instrument is basically, it's not necessarily need to be traded in the open market, but these are something which is denominated, settled, originated, everything will happen only by monetary terms. And that is what we need to really understand moment we come down to something called as a financial instrument. For example, when we speak about financial instrument, we generally, start with a very small little idea that was these comprise financial assets and financial liabilities. This is what your basic split is all about, the financial asset and the financial liability. Together they are identified as something called as financial instruments. Gone are the days when we used to look at the balance sheet and say that this is fixed asset, this is current asset. Those days are dead. Now the fellows are calling it as non-current, current, adun dead. In terms of functional approach and conceptual base, we don't really care about that. So when you speak about tangible, intangible kind of assets, then you come across something called as financial assets. You cannot consider investment in share as an intangible asset, can you? Or are they tangible assets? They are neither tangible, they are neither intangible nor intangible. What do you call them as here? They become something like a financial asset. So when we speak about a financial asset, we need to understand that they are a bit different from others. Now, how are they different? To put it in very simple terms, your financial assets and financial liabilities are instruments which originate in cash flows and are expected to be settled in cash or another financial asset. This is a very simple and straightforward definition of anything called as a financial instrument. So how do you understand, sir? Very simple. For example, if you have invested in debentures, understand this, invested in debenture. What was the starting point? We paid money at beginning. Clear, that is what we did, or we invested money, so to say. We invested money at the beginning. How is the debenture expected to be settled? We expect to receive cash. Undaliya, origination by cash, ending by cash. This is an example of a financial instrument. So what about convertible debentures, sir? We paid cash. You don't pay convertible debentures, by anything other than a cash. Technically, there are instances where under a liability is settled by issued debentures. We are not looking at that. For standard model, where you are going to standard normal cases, you are going to invest your money and then finish it off. You pay money at the beginning and we expect to what? To what, sir? Paid cash or equity. Again, we technically deal only with an optional convertible debentures. Mandatory convertible debentures are technically called as equity. We'll come down to that separately. So what's your idea, guys? A, the settlement is expected to be when, sir? Expected in cash or The settlement is expected in equity shares. For equity shares, if at all it is being settled, how do you think they will settle? Yes, future dividends or distribution at the time of winding up. Even this is expected to be what here? Settled by cash. So what does it typically understand? That we can understand, sir. Therefore, investment in equity which we expect to receive is also financial asset. You're able to appreciate what I am driving at. Now I have made 2 points here. Point number 1, when you're having something like a debenture, as on your expiry date or as on your maturity date, you are expecting to receive cash to close out that so-called investment that you have made. Are we clear about that? That's a very straightforward. Moment you're going to receive cash, point time 0 also I paid cash, maturity also I'm going to receive cash. It's a pure, simple financial transaction that is taking place between two parties. This is a financial asset. Are we clear here? The other side. What if we are going to have something like a convertible debenture? I told that, okay, one end you may expect to receive cash, another end you may expect to receive what? Shares, equity shares of the issuing company. Now I said that, like, boss, even if you are going to receive equity shares for settlement of your debentures, you will still call that as a financial asset. Yet the investment in debentures today. Why? Financial assets include investments which are originating in cash flow. Yes, even convertible debentures originated today by payment of some money, expected to be settled in what? Cash or some other financial asset. Then we were trying to look at the equity shares. Supposing I'm investing my equity share, investing my money in some other company's equity shares, how do I expect to be rewarded for that equity share? We typically look at only two alternatives. I can sell it sometime in the future, or alternatively hold it till the company is going to die, or you are going to die. But technically we assume that instruments, when at the time of your so-called ending date or whatever, will get some amount of money from your company on account of distribution of whatever is left over after settlement to your shareholder, outsiders liability. What do you mean here? Ultimately, even if you are holding equity shares in a company, ultimately you are expected to be paid by what? Cash. Therefore, equity also becomes a financial asset. And look at the first statement right now. I can pay cash, close it. I can pay you at another financial asset and settle it. It's like telling that I will pay you cash or I will pay you check madri. Checkum kadasila cash at some point in time in the future. Same logic. Even if I'm going to give you an equity, you're going to get only cash sometime later from your company. So either case we'll call that as a financial asset. Fair enough here? Yes? So understand this. Same logic is applicable even for your financial liability, originating and also settlement. Both are pretty much considered that way. Overlook structure clear. So one of the primary point that we are trying to make here is that origination, closure, both should be in cash. Closure can also be in some other financial assets. Fair enough, guys? Everybody here? Let us look at this entire stuff. So when we speak about your financial instruments, we speak about technically financial assets and financial liabilities. So when you speak about financial assets, you are effectively looking at cash. First and foremost, cash itself is a financial asset. Straight away. Cash is always a financial asset. Then you'll also come across what? What here? Investments which are expected to be settled in cash or other financial assets. It also includes loans and receivables which are expected to be settled in what, guys? Cash or other financial assets. And also, please,